All right, everybody. I'm excited for this. Not many people are excited for taxes, but this is actually an exciting bill, and I think you guys are really going to bring, you guys are going to get a lot out of this, and it's going to be some big changes, some small changes, some extensions of the 2017 TCJA Tax Cut Job Act that was happened back then. And so what we're going to go through is all the different elements that apply to really most of the clients that we work with. There's 870 pages, so there's only so much that we can go through. So we're going to take the majority, the big rocks, the things that are applicable to you, and make sure that you guys are able to really take something away from this big, beautiful bill. And with that, just want to kind of introduce myself, David Ortiz. If I haven't had the pleasure of meeting you, I'm over here on the legacy and succession team, and I help out with the succession planning and tax planning. It all really folds together, and we're really dedicated on helping business owners with the complexities that come with getting their business ready now and in the future, and taking advantages of tax planning along the way. I'm an IRS enrolled agent, certified financial planner, and a certified exit planning advisor. So I geek out about this stuff. And the reason why is because there are so many different codes out there within the Internal Revenue Code that really benefit and encourage entrepreneurism and investors investing in these markets. And so we want to take as much advantage of those as legally possible. And that's why it's important to know what's going on. And so how this is going to work today is we have an opportunity to just chime in on the chat function. So put in your questions in there as we go. I'm going to try to pay attention to slide and questions, but Teresa's hosting, so she'll nudge me if there's anything. So as I'm going through this presentation, just put in a question before I move on too late, and don't miss the opportunity to ask out on something. The next thing that's really important I've been telling people is not every single thing I'm going to talk about today will be relevant to you. However, the topics that are relevant to you, write them down. Then with your tax team, or if you want to talk to us, we're going to open up a 30-minute free tax consultation for the attendees of this webinar. And we can go through those specific things that are more customized to you to see if there's any opportunities for you to take advantage of some of these new tax changes. For those that are just joining, once again, I'm David Ortiz, and I'm the tax and succession guy over here, and we're real excited to get this going. Feel free to comment below whenever you have any questions, and we're looking forward to diving deep. So just to kind of give you a bit of a roadmap of what's happened and why this is so significant, the House passed the bill with a narrow 218 to 214 vote, and it was obviously very contentious on the Senate as well with a tight 51-50 vote. Vice President J.D. Vance was the tiebreaker, so we can tell which side kind of benefited on this tax change, as you can see. The interesting thing is this was enacted on July 4th, and it was the 249th anniversary of the Declaration of Independence. And it is a significant shift in the tax policy. So big things happening, but there's also a lot of confusion because I've been on multiple tax strategy calls, and there's a lot of confusion because AI is not helping at all. Usually AI helps us, but when understanding this bill, it doesn't happen. A lot of people try to download the PDF, which is 870 pages, and then ask all the questions to ChatGPT. Well, the problem with that is how the bill is read is it's reading, for instance, on the child dependent care tax, it says cross out $5,000 credit and give $7,500. on IRC section 453 or whatever the section is. So the problem with that with AI is they're not able to go back to the Internal Revenue Code, interpret the context, and then insert that change in there. So we have to go the old school way, go through the PDF and actually read what the section is. So to be helpful, over each change, I put what section it is. I even, on most of it, I put the page number that you can find in the PDF to check on as well. And so I wanted to be as direct to the source as I can and be as simple. So just because you see it online doesn't mean that it's actually true. Something I may not even be 100% correct today, and I may have to come back and say, hey, this is how it was interpreted. But for the most part, I went to the raw source and was able to cite it so I could get you guys the best knowledge moving forward. Now, if we take a step back, we can look at what are the core objectives? What are they really trying to accomplish over in Washington? And really the goal was, okay, well, Trump enacted the 2017 TCJA Act, which was huge for the tax code. Really benefited business owners a lot. And we saw a big boost in the economy because because it really stimulated a lot of business growth. A lot of concern was at the end of the year, estate taxes, income taxes, a bunch of other areas that were less tax were now going to sunset and we were going to see a big boost. But fortunately, they gave us enough time and didn't do it in the final hour of the year and gave us a few months to really prepare for a lot of the changes that are happened this year and next year. And so the tax bracket staying the same, so it's still the 10 to 37% tax bracket. But the threshold is a little bit different. So if your income is $751,000 if you file jointly, then that's when you start creeping in. That's when you get into the 37% tax bracket. So if your income is $800,000 and you're married, then it's only the $50,000 above the 750,000 that's taxed at 37%. So we're not doing the 39%, which is what a lot of people thought. We're staying the same on our taxes. It's 626,000 for single if you file single on the highest tax bracket, which is decent relative to our historical averages. The next is the estate tax reform. This was one that many people were biting their nails on for the ultra high net worth. And the estate tax exemption is now permanent. There is no sunset like there was in 2017, and it will be at 15 million. I'll go to more detail about that later. Now, if you're more environmentally friendly and you took advantage of a lot of clean energy tax credits, those are all going away. Most of them are, not all, but most of them are going away. So if you want to buy a Tesla, you better buy a Tesla by September, else you're not getting any type of credit. That's just how the bill had to give and take, and it took a lot away from the clean energy, which was no surprise there. There is a significant fiscal impact, which they're adding nearly $4.5 trillion to the federal debt by focusing on increasing defense and security, where they're going to spend hundreds of billions of dollars there. That's a whole nother conversation. It just feels like fake money at this point. So I don't even know how significant that is because we just keep adding on. So we're just going to focus on what we can control and focus on how we can benefit our families and communities. Lastly, something very interesting that I kind of wanted to point out here for Oklahoma specifically is we have a rural hospital crisis going on, and with the new Doge that came out, it really crippled a lot of our rural hospitals. I was just talking to some individuals that were at the state level yesterday, and they were mentioning multiple medically owned hospitals, privately held, were having to shut down because they lost a lot of funding. And so this is a really great bill where they're going to increase the hospital fund by $10 billion a year starting next year for the next 5 years. For states like Oklahoma, this is huge because we do need a lot of help over in our rural areas. And hopefully we can, as a state, be some of the first to be able to access that funding. Now let's move over to presidential priorities. And this whole bill had different chapters. They had focused on business and middle class, communities. There's different sections. So what I'm going to do is I'm going to go through and kind of take the major components, the major meat out of these chapters and kind of break them down for you. I have to start out, of course, first with the biggest confusion, the biggest rumor, but that's the Trump accounts. So if you're gonna do a huge bill, you got to have something with your name on it, of course. You've heard MAGA accounts as well. Well, the official title is Trump accounts, and it's a good one. It's good. And really where it can helpful is if you have a kid who is born after January 1st, they can have a traditional IRA, but they don't have to earn any income. Right now, what we've experienced is you hire your kids, you pay them money, but that money is earned income. So then they invest into their IRA that way. But now they don't have to have earned income as a kid to have money in their traditional IRA. There's been confusion about it being a Roth IRA, but it is a traditional IRA. So money that goes in is going to be taxed out later. And the interesting thing about it is, for me, I have 3 kids, and I have a 3-year-old, a 1-year-old, and a newborn. I can't open this up for my 3-year-old or my 1-year-old, but my newborn, which she was born in March, I can contribute up to $5,000 inside this for her, and I have to do that before January 1st, 2029. That's when we're not going to be able to contribute unless Congress lets it keep going. What's cool is they do give you $1,000 tax credit, so you must elect it on your tax return. Your CPA is not going to know that you did it, so you got to tell them if you end up opening one of these up so you can get that tax credit. For employers, it depends on how robust your HR team is if you want to tackle this beast, but you can also put it as a benefit, and you can contribute up to $2,500 to your employees' kids' IRA. One caveat here is you have to only invest in index funds or mutual funds, and it can't exceed an annual fee of 0.1%. So really just playing it safe, using some Vanguard index funds is a safe play here. Not sure how they're going to monitor that, but it doesn't hurt to just do some low cost index funds in these and let them grow. Just remember, money goes in and it gets taxed when it comes out, just like a normal IRA. Some other things that a lot of people had confusion about was the tips exclusion. I've heard different things where people say, okay, it has to only be cash tips or only non-cash tips, or I don't usually get tips, but now I'm going to open it up because I can exclude it from my taxes. Well, hold on. None of that's true. Really, where the phase out is okay, if you're under $300,000 of adjusted gross income, then you can exclude up to $25,000 in tips from your reportable income. Single filers is half that amount, 12,500. And there's a phase out between 300,000 and 550,000. You don't have to remember what that is, but if you're over that income threshold, talk to your tax advisor and they'll let you know how much you can exclude. Now, you can't just open up a business and start opening tips. You have to be in a business where tips are normal. So obviously restaurants, hair salons, um, valets, they're already receiving tips, so they qualify. There's going to give a more detailed list of these professions in October, and that's when you will know a little bit more about what they're going to do there. But if you don't regularly receive tips, then this does not apply to you, and you will be fined. So tax on overtime. This is interesting because a lot of our clients are construction companies and they have a lot of clients that work overtime. Employees that work overtime. These are, there's some confusion around this, but here are the simple rules. If they're under $300,000 of adjusted gross income, they can exclude up to $25,000 in income from overtime. But you can only exclude the half portion of the 1.5 times your hourly wage. And they have full time means over 40 hours. So if we were to play out a scenario, you have John and he works, 50 hours, and that 10 hours gave him an extra $15,000, let's just say for easy math. The $5,000 is what's excluded from the income, not the full 15,000 that was in overtime. It's only that extra half. So this is really important to tell your employees if they file their own taxes, which most of them may do. Let them know that they can exclude that portion of the overtime and and take advantage of that because it's there. And be sure you guys go ahead and if you have any questions, put them in here. Feel free to interrupt me and ask me some questions along the way. Maybe I'm just doing a great job explaining it, but feel free to ask any questions.
David, just to interrupt, they can just drop their questions in the question answer box. And then you and I will be able to see them there. So just drop them in your Q&A box.
Gotcha. Wonderful. Thank you. Car loan interest. So this is interesting because it's kind of its own category. I don't know if we're recommending people to get in more car loan debt, but hey, it's a deduction regardless. But there are a lot of contingencies here, so really pay attention. Don't get too excited. Basically, the good thing about it is you have different deductions. So when you have your gross income coming in, you then adjust that gross income with certain deductions. Then you use your standard or your itemized deduction to get your taxable income. Well, what's interesting is this is a midline deduction. It comes after you adjust, but it comes before you deduct the standard deduction. And the reason why is it's giving people who don't itemize, which is common now because the standard deduction is so high, most people don't itemize, that you can actually deduct it without even itemizing. And you can deduct up to $10,000 of interest. That's going to be a very expensive car. Yes, Teresa.
Yeah, it looks like we have 2 questions. Can you see them on your end?
Oh, yeah.
Okay.
We got one of them says, is it up to the company to adjust the overtime tax on their pay, or does the employee just apply back for the taxes when they file their taxes? So if I understand correctly, the company can they can tell their clients and say, hey, I'm going to maybe pay you a little bit less in hourly wage because you get this amount of overtime. And if you look at the net after tax return, then this is the amount I do. That I would not recommend. That's going to confuse the heck out of that employee. Just keep it the same and say, hey, you need to file for this on your taxes. Just don't forget. So let them know that they can do that portion of it. So if you have any more questions, you can ask me on that if I answered that correctly. We have another one. Is the overtime exclusion available without meeting any itemized deductions? Correct. You don't have to itemize to get the overtime exclusion. You just have to be under the income threshold, which is the $300,000 adjusted gross income. If you go above that, there's a phase out, and that's a complicated formula that you need to work out with we can work that out later. But yeah, you don't need to itemize to be able to get that overtime exclusion. Do the rules on car loan interest apply to vehicles financed before this year, or is it only new contracts moving forward? Great question. It is only moving forward. So it's only new vehicles that apply. You can't refinance and get that. So it's only for new automobiles. They're just trying to stimulate the new auto market, and it has to be at least under 14,000 pounds, at least 2 wheels, and that's the only way you can get that. Great questions. All right, moving forward past car loan interest. Oh, do payroll companies have to add an additional line item on the W-2 for the overtime? That's an HR question, but I can kind of think of what that's going to look like. I wouldn't say they would have to. I'm pretty confident they're not going to add it. They're just going to have to show how much was overtime. Now, an employee may come to you and say, okay, I'm not good with math. How much did I get? That's half times premium. And then you just calculate that for them, and which is a simple computation. So, if you want to, if you are in payroll, it might help, because what's the harm in a spreadsheet? And that'll take a few minutes to show, here's the amount that you can exclude from your taxes. That's really going to be helpful to the employees, and one, it will help them remember. So you can send out a list to everybody that had overtime and send an email and said, hey, don't forget when you're filing taxes, here's how much you can exclude from your income, and that will help them out. Great question, and it's really up to the HR department. Moving forward. Okay. This one is huge, and this is the one that probably gets the most headline. So I'll just go through it. Please ask questions, because there has been confusions about this one. For a lot of the companies work with, they're asset heavy, and most depreciate as soon as they get it because they just don't want to pay taxes. We'll figure it out later. Currently, right now, it started out with 100% bonus depreciation, and then it's just been phasing down each year since 2017. And so this year there's a 40% bonus depreciation. You buy an equipment for $100,000, you can depreciate it by $40,000 that you can write off on your business. But now your $100,000 cost basis is now $60,000. So if you sell your equipment for $80,000, you're going to have to pay $20,000 in income tax on that. So figuring out that's called depreciation recapture. Figuring out how much you buy and sell equipment is really important here. Next year, it'll phase down to, it was going to phase down to 20%. And then 2027, there would have been 0, but that is not the case anymore. So everything I just said is under the new provision, you can bonus depreciate 100%. So that $100,000 of equipment you just bought, you can depreciate $100,000 of it. Your cost basis is 0, so anytime you sell it, you're gonna have to pay income tax on it. But if you have a big income year, why not take advantage of that? The thing that catches most business owner, we have a question here. So is it 40% for property acquired between January 1st of 2025 and January? Yep. So great point. If you bought an asset this year before January 20th, you do not get to bonus depreciate it. I know it's kind of weird. It'd be nice if it was January 1st, but it's not that easy here. So January 20th, if you buy it on then or after, then you can be subject to the 100% bonus depreciation. If you've bought something before then in the year, you can't. You're still under the 40% bonus depreciation. So talk to your tax advisor about what that would look like if you should do that. And that goes into planning. Most business owners don't plan, they just depreciate as soon as they get it. And that may not be the most efficient way, and most CPAs are just going to take your order and do it. But you've really got to sit down and think, okay, what am I going to do with this business? what is my exit plan or succession plan? We're working with a lot of business owners right now who are going to transition out of their business and sell it in 3 to 5 years. So we need to make sure that we can depreciate as much assets as we want now, because if we sell it, the company at a stock sale, the buyer comes in, they take the business and the assets at their cost basis, and the owner doesn't have to pay for the depreciation recapture. However, if you do an asset sale, you will have that depreciation recapture and you will have to pay income tax. So when you sell your business, you're going to be in the highest tax bracket that you're higher than you're usually at, because your income is going to go crazy up that year. So if you're having to pay everything at the highest tax bracket in 3 years on an asset sale, maybe it doesn't make sense to do a bonus depreciation this year. So figuring out what your exit plan is, if you're able to do an asset or stock sale, those are all planning considerations. There's many more that come with it. And with these new changes, means more responsibility for you to really sit down with your tax team. Or if you don't feel confident in your tax planning team, we'd love to sit down and see how we can help you out there, and figure out, you know, what the right moves are before you just pull the trigger. Now, Section 179 and bonus depreciation kind of get confused a little bit, because they both virtually do the same thing, but they just do it in a different way and have different restrictions. Section 179 has more restrictions, but what you do is you can take a single equipment, and currently you can depreciate, you can write off up to 1.25 on it, and the equipment can't be over $3 million, $3.13 million. Now you can write off up to 2.5 million, which is double, huge benefit here. And the phase out is above a $4 million in purchase. So if you're buying a skid steer and it's, you know, let's say $2 million, you can write off that full $2 million. But if it's, you know, $5 million, then there's going to be a phase out there, and you may not get that full 2.5 million. So you really got to work with your tax team to figure out what that true depreciation is, that write-off. So Section 179 got a big boost, a bonus depreciation. Really, the government is just saying, buy, boost our GDP. We'll sacrifice on our taxes now so we can boost the economy later. So the government's taking a hit on taxes so they can boost manufacturing and boost the economy that way. And that's what they're trying to encourage business owners to do. Qualified production property. This is really for those that we have a few manufacturers on this call, but this is really applicable to you. Your factory manufacturing buildings can get an 100% write-off, which is way better than a 39-year depreciation schedule. Now, there are some caveats here. If you manufacture, produce anything, and you renovate or convert it, it applies, but you can't use the square footage on the office space, the administration area, parking, sales, etc. Indirect labor is not included. Indirect labor is like office staff that's not actually out there manufacturing and building it. So they're really, with the new tariffs, they're really trying to boost more American production and manufacturing. Really pay attention to that if you are in that world creating widgets. Okay, so I'm gonna give you guys a second to ask a question before I move forward. All right. 1202, we'll talk about in a second, but right now, if you deduct interest, business interest, you can only deduct up to 30% of your adjustable taxable income. After January 1st, there's deductions for depreciation, amortization, depletion, and they're not added back to the taxable income, but now they are. So what that means is you can deduct more interest based on your EBIT, not EBITDA. So talk to your CPA, because just making sure that they catch that. Write that down. It's Section 163J. and talk to them. Pretty much all business owners on this call need to make sure you talk to your CPA that they're now giving you that extra interest deduction, because otherwise you're just letting free money on the sideline there. Not a huge jump, but enough to be significant enough to make it happen. The fun one is this next one, which is qualified small business stock. Under section 1202 of the Internal Revenue Code, you can exclude up to $10 million in capital gain from small business stock held greater than 5 years, but you can't have more than 50 million in assets. Whether you knew that or not, this is only for if you're an S corporation, it doesn't count. Pass-through entity doesn't count. C Corp does count. The reason why is the government was incentivizing C corporations because you have to pay money coming in and pay money going out, so they get more in income tax. So they want to incentivize you on the back end when you sell your company to get a huge exclusion. So currently, and this is important because no one here really qualifies unless you just started a C Corp in the past week for the new rule. But right now, you can exclude up to $10 million in capital gain. For instance, if you have a company that you sell for $20 million, you're going to pay only taxes on $10 million of that gain. Because if you file for that, if it's a qualified stock, it meets all the rules and regulations. You work with the tax attorney on that years before you sell to make sure you qualify, then you can exclude up to that gain. That's a huge amount of tax savings. However, now, if you start a C corporation, or if you're an S corporation and you move over to a C Corp now, and you hold for at least 5 years, you can exclude up to 15 million. So if you sell your company for $20 million, now you're only paying $5 million of gain. But the $5 million of gain is taxed at 28%. That's really key. Typically, a capital gains rate at the highest tax bracket is 20%, plus 3.8% net investment income tax. But with this, if you use the qualified small business stock exemption, 1202, you have to pay 28% on the gain. But 15 million of it's wiped out. I'd say that's a great trade-off. But it's worth calculating in tax planning, because if you're planning on exiting in 5 years or so, you need to be looking at this. You need to be looking at seeing, maybe I should turn my S Corp into a C Corp, and then start figuring out, okay, here's how much I'm saving in taxes now because it's passing through to me. And here's my tax liability if I'm a C Corp, but here's how much I save on the back end. So it's a really important part. Yep, only applies to C Corps. So that's why you need to figure out if you need to transition your company over to a C Corp or not, if you have that time period. Now, if you only have 3 years, you can actually exclude the 50% of it. So that's $7.5 million you can still exclude. If you're selling your company for $10 million, you can exclude up to $7.5 million of that. So you're only paying 28% of federal capital gain on $2.5 million. You got to calculate. If you're cash flowing a ton, it may not be worth it with all the deductions you get with being a pass-through. So really having that scheduled out is important. If you hold it for 4 years, you can exclude up to 75% of that 15 million. But as long as you hold it for 5 years, you can get the full $15 million exclusion. And it's really got to be a really crucial part of, with this new tax change after July 4th, it's got to be crucial in your exit plan. And really figuring out those numbers if it makes sense, because there's a whole nother rabbit trail setting up a C Corp. If you get enough gain, it may be worth it. All right. Qualified business income, QBI, section 198, whatever you call it, it's staying the same with a minor tweak. Right now, the income threshold is about $394,000 plus $50,000. So that $394,000 changes each year. The IRS has an income threshold, so it'll keep going up with inflation. Right now, you can add an extra $100,000 instead of $50,000. So it's around $494,000 of income to qualify for QBI. QBI is where you take 20% of your qualified business income and you get a deduction. So if your QBI is $1 million, you can deduct $200,000 from your taxable income. That's significant tax savings. Now, with this, you have a little bit more room there. So if you do bonus depreciate or Section 179, it's really important to understand maybe this is the year I need to depreciate everything so I can hit that income threshold so I can get that QBI. So there's a lot of moving parts here that you can really take advantage of that your tax team or we can handle and figure out with you as well. So that's a great win that you get to keep QBI. It's just free money from the government just because you're a business. And it's a really good opportunity. Permanent changes. This is kind of a hodgepodge of different things that they're just putting into place that people weren't sure that they were sunsetting and what that would look like. The estate tax exemption will not sunset. It's $15 million per individual starting in 2026. So right now, you can't use the $15 million exemption. It's a little over 14, but it's really close. How it works is you have 15 million, your spouse has 15 million, so you can aggregate using a DSU and you can have a $30 million estate. However, if your estate is $40 million, then that extra 10 million that you have past the estate exemption is the death tax. So when you die, is 40% of that. That's $4 million. So it's still important to do estate tax planning, but this is a great win for the ultra high net worth. And you still need to really consider planning in the long run because there's a lot of opportunity there. Child tax credit went from $2,000 per child to $2,200 per child, and it's going to adjust with inflation. So that's great, especially me having a lot of new kids. I'm very thankful for that. Standard deduction is going to be at $30,000 and just continue to grow with inflation. So that's permanent. It was going to be cut in half and go away and revert back to the pre-2016 time, but that's going to be stayed intact. So if you itemize, or don't, this is really important. There is some confusion though out there on personal exemptions. Back in the day, you could have a personal exemption and write it off on your taxes, even if you didn't itemize. Now, you can't do that. However, they have allowed 65 plus year olds to have a personal exemption up to $6,000. So you can write off certain personal exemptions, and that's an easy Google of what that is. And you can take that $6,000 off of your income. However, if you take Social Security early, you do not qualify. If your income is below $150,000, married filed jointly, you do not qualify. $75,000 if you're single. So if you're above $150,000 in income, married, or you've taken Social Security early, you do not qualify for that personal exemption. I think there's some confusion out there thinking that Social Security wouldn't be taxed. That's not the case. Sorry. Now, for the SALT cap, this is only from 2025 to 2029, but I just didn't want to make a new slide for that. Sorry. So it's only this next 4 years. Currently, SALT is your state and local taxes. So if you make $100,000 in income tax in Oklahoma, 4.75% commission goes to Oklahoma. So you're taking $4,750 and you're paying the state of Oklahoma your state income tax. Then you got your federal income tax. Now, what you can do is you can take that amount, and if you're a high income earner, so it's kind of an awkward thing. This $40,000 cap is for high income earners, but it's only capped out at 500 to 600,000. So it's just kind of like a really small set of people who are going to be able to max out this cap, but also be on the threshold. Just kind of a weird dynamic there. I think they should have raised the income, but I don't make the rules. So if you're in Texas, you don't have state income taxes. But where do they tax you a lot? Your property taxes. So you can still, if your property taxes are significant enough, if you haven't itemized before, you maybe need to reconsider that. If you haven't itemized because you haven't been able to hit more than 30,000 in deductions, this may be worth considering if you bring in a lot of income. Now, if you're saying, hey, David, I bring in $1 million in income a year that I pay taxes on, 47,500 in Oklahoma, I have to pay Oklahoma, state of Oklahoma. I don't qualify for this. But just remember, currently, there's a thing called the pass-through entity tax, PTET. And what you can do is you can deduct your state income tax as a business expense. So your pass-through entity, this has to be a pass-through entity, of course, like your S Corp or LLC, your pass-through, and you can deduct that against your business income, and so you really need to talk to your CPA about pass-through entity tax if you're phased out from this range. If not, consider this itemized deduction. Feel free to throw any questions in there. Hopefully you guys aren't getting fatigued, but hopefully it's making sense here. Try to make this as simple as possible, which was really hard to do. So we'll see if I'm doing well there. Corporate charitable giving. So if you have a business, you can't deduct your charity giving if it's less than 1% of your profit. So if your profit is $1 million, then you have to be giving more than $10,000 to be able to deduct that from your business. But you can't be giving more than $100,000 in this situation. You can, but any amount over that $100,000 won't be included as a deduction. So there's a floor and a ceiling, very simple there. If you're tax conscious, which probably are since you're on this call, that's really important to know, especially if we have some big charitable givers in here. So take that into account. For non-itemizers, so if you don't itemize, then you're like, well, if I give to charity, I don't get to write that off. I drop something off at Goodwill, or my church gives me something to prove how much I've deducted, I've given, but I can't use that. Well, after 2022, if you're single, you can even if you're not itemizing, you can deduct up to $300 if you're single and $600 if you're married from your income. Now, if you don't itemize, and let's say you tithe $3,000 a year, you can take that $2,000 at least up to there if you're married, and you can deduct that from your income. So, encouraging a little bit more charitable giving, I think that's a good thing. So let me move here real quick. Give you guys times to think about any questions you have. And if you do itemize, then you have to give at least 0.5% of your AGI in charitable giving to get a charitable deduction. So if your AGI is $100,000, then you need to give at least $500 or more to be able to include that as part of your itemized. That's one note I had there. It's a little small caveat. Okay, so family and education benefits, if you adopt, they've increased the enhanced adoption credit by a little bit. So that didn't revert. It actually increased a little bit. If you pay for childcare of any type, then now you can deduct up to $7,500 of those expenses versus $5,000. So if you pay previously, if you've paid $6,000 a year in childcare costs, you can deduct up to 500,000. If you're not itemizing, it doesn't matter. Now you can deduct that full 6,000 because your limit is 7,500. Also, if you have 529s, they've just expanded more qualified expenses. So you can take a look at that as well. Okay, we're moving into the last big thing before we kind of do a little conclusion and a little wrap up. So be thinking about some questions you guys have. Qualified Opportunity Zone funds. This has to be one of the most confusing parts of this whole bill. And it's different every time you ask someone. So I'm going to try to get in the weeds, but not too in the weeds here, because I don't have to come back with an email saying I was wrong. But from reading over this in section 7421 of the bill multiple times, I'm pretty confident in what I have up here. So currently, is the corporate charitable deduction only for S and C corps? Yeah, so it's only if you're a single member LLC, I don't think it applies. So it has to be an LLC that's, filing as a S corp or a C corp. But I think I can look in just to make sure. That's a great question of what they mean by that, because there's limited partners, there's all those, but I'm pretty sure it's S corp and C corp what you're saying. I'll follow up with you on that one. Let me know if anyone else wants to know if that's important. Mitchell. Okay. Teresa's got that. I'll let. Okay, so currently right now, a qualified opportunity zone in 2017 was designed to be areas of impoverishment of a certain range. And what they were trying to do is stimulate these areas. So what better way to stimulate areas than encourage investors and business owners to invest in the area and give them tax advantages? So a qualified opportunity zone was really an exciting thing that it built up a lot of momentum, but not as much as most people thought. It really just became a multifamily real estate onslaught. The government was really hoping that there would be more businesses that would be built in these opportunity zones, aka impoverished areas, but really it was just a bunch of apartment complexes building. So they kind of changed, they kind of learned from that and made some changes on here, which I think were good. But for those that have invested in qualified opportunity zone fund, what do we even use it for? What is it? If you have any type of gain on any stock or real estate, then you can defer it into this qualified opportunity zone. A lot of real estate investors, because most opportunity zone funds are real estate, this is an alternative to a 1031. So because you can actually defer the depreciation and the capital gain into the qualified opportunity zone fund, but basically by the end of the year, so next year you have to pay taxes on it, on the gain that you made before you put into the fund. Any growth after for 10 years, if you hold it for 10 years, any growth after, it's a full step up, which means you don't have to pay any taxes. So there's a lot of tax benefits there. Currently, if you hold it for 5 years, you get a 10% step up in basis and an additional 5 after 7 years. And so where this is helpful is now we're kind of in this awkward phase with this qualified opportunity zone. Basically, for the next year and a half, it doesn't make a ton of sense to invest in a qualified opportunity zone or a qualified opportunity zone fund. The reason why is because if you put money in now, that gain you're trying to defer, you're just gonna have to pay it next year. And if you invest in it next year, you're gonna have to pay it that same year. So it doesn't make sense. But starting January 1st of 2027, if you defer any gain into this qualified opportunity zone fund, then you won't have to pay taxes on that gain until until December 31st, 2033. So basically in 2033, that's when you recognize the gain. Now, if you hold it for 5 years, you also get a 10% step up in basis, 30% if you're in a qualified rural opportunity fund. And if you wait another 5 years, so 10 years total, you still get that same full step up. So what's great is you pay taxes in 2033, or when you file April 2034, and then any growth you get after is all tax-free. Now, if you hold it longer than 30 years, the exclusion goes away, but I don't know how long you want to stay in these. I want to give some pros and cons over here. This is what we talk with the clients that get into these type of funds. Is we always want to look at the tax equivalent yield. Does the tax equivalent yield? That's truly what you're looking at. So if something's if this multifamily real estate you invest in only grows at 4% a year, that's tax equivalent yield. If it's 10% on another investment and the tax equivalent yield is 7%, well, pay the taxes now and just go into a better investment. So we got to be careful on what type of qualified opportunity zones we get into, QOZs, or what type of funds we get into, because the fund may go down in value. Who knows? Are they going to be able to lease the tenants in these areas? Is it going to, there's all these questions. So you got to think about really what you're buying and look at it that way. So we do believe that real estate is an important part of a portfolio. And if you don't have exposure and you want exposure, this might be a great area to get you in while also getting tax benefits. And that's typically when we see people who have a massive capital gain or have a lot of depreciated asset real estate go into these. And we'd love to talk with you more about that. Key takeaways, you guys got a few more minutes to ask any more questions. And as I'm wrapping this up in the next 30 seconds or 30 to 60 seconds. So be thinking about any questions you have or just schedule a follow-up. Once again, there's a tax consultation we can have, 30-minute free tax consultation. So reach out to Teresa or me and we can schedule that. But key takeaways. This is definitely one of the bigger tax reforms. The last biggest one was when Trump came in and did it in 2017. He's obviously a big real estate investor, big business owner, so it really reflected his kind of people. So it wasn't a big surprise that real estate and business owners got a huge benefit and green energy didn't. Yeah, we videoed this, and Teresa's going to be able to put it on YouTube as well, so you can look at the first half. Great question. Business incentives. There was just a ton of big business incentives. Wealth transfer planning is very important. Timing is important. Just because someone gives you a bunch of candy doesn't mean you should eat it right now. If you eat too much candy, there's going to be, what happens. And so you got to strategically eat your candy. And right now, business owners or real estate investors are drooling because these are some great tax benefits, but we just got to be very strategic on how you're planning on doing this. One is you've got to know what your personal wealth goals are. Second is you got to now align that with your business goals. So taking that into account before you do your tax planning. Versus it's other way around usually. It's I don't know what our growth goals are. I don't know where we're headed, but I want to take deductions. Well, maybe that's not always the best situation. So walking through what your personal goals are, what your business goals are, having those aligned with your tax plan, you're really it's America. You have great opportunities here. Government's giving you great opportunities. And so that's really where we want to be a partner there on your tax planning team. We're not here to replace your CPA. We're here to be a team player because we take in the full wealth picture, the full goal, and that's where we kind of are helpful on the tax planning. So we work with our clients' CPAs all the time, and we help the clients achieve the goals that they're wanting with the opportunities set in place. We really appreciate everyone on this call today. We thank you for coming on and listening. We want to continue to help out. We have clients and non-clients on here. So if you are a client and we haven't really got to sit down and look at your situation, we want to, and you didn't even know these are some of the really great options we have. We want to dive deeper with you there. If you're a non-client, we want to be able to sit down with you and hit your goals and key takeaways. We're happy to also facilitate conversation with you and your CPA as well as an ad hoc tax consultation, and we can go through that further. Without ado, I think that's in with all of our questions. You're so welcome. Thank you. Appreciate you guys. Without ado, we are adjourned, and we will be in touch. Everyone have a great day.